This objective introduces you to the major financial statements that we use in financial accounting, that everybody uses in business, and so forth. There are four major financial statements that you're introduced to here. We are going to be focusing in on three of them in this course. You'll have a focus of the fourth one in your Accounting 204 course. So not only are you going to be introduced to those financial statements, you're also going to be preparing them, learning how to prepare them this weekend for your homework. So the very first financial statement that's very important is this: the only financial statement that tells us whether the company made a profit or not. And a matter of fact, if you're in business, that's really what you're in business for, right? Did I make a profit or not? Well, the income statement is the only statement that tells us that. And the income statement summarizes all of the revenue that the company makes. Now remember, revenue from Learning Objective 2. Revenue is what the company is collecting from its customers by selling them, whatever they're selling. Right? So revenue is directly related to selling things to customers, right? You're either selling goods or you're selling services or both. But either way, you have to sell something. That's revenue. So revenues are listed on the income statement and compared with expenses. Expenses are the costs of doing business in order to sell what you're selling. And so that difference, of course, tells you whether you have a profit or not. The income statement is the financial statement that tells us that answer. Is the company profitable? Okay. So once a company is profitable, the question then becomes, whose profit is it? Whose profit is it? And it's an obvious answer. If you own the company, the profit is yours. Okay, the owner's profit. So we are looking at accounting here from a standpoint of a corporate form. And so corporations are owned by shareholders or stockholders. And so the profit of a company belongs to the stockholders, belongs to the shareholders. Okay. Now, if you were the owner of a business, regardless whether it was a corporation or not, and your company made a profit, what would you want to do with that profit? Well, most business owners would want to put it back into the company, right? Keep it in the company and use it to help the company grow in terms of selling more of its products or services. But what else can happen to the profit of a company? Well, yes, most owners would like to keep it in the company, but sometimes they like to take a little bit of it out. Okay, so what could also happen is what you learned about a Learning Objective 2 is the company could share a portion of the profit in the form of a dividend. Right? So corporations, when they share a portion of that profit with the owners, that's what a dividend is. So there's an actual statement that tells us the story of what happened to that profit. It's called a retained earnings statement. Now, here is something that you need to understand. There are interchangeable terms in accounting. Remember, the term income statement basically tells us whether we had a profit or loss. So the word income is synonymous with profit. Guess what other word is synonymous with profit? The word earnings. The word earnings means profit, which means the word earnings also means net income. As a matter of fact, yesterday, since we were talking about the stock market earlier, this whole week has been an earnings week for Wall Street. 20% of the S&P 500 companies are reporting their earnings. Now, when a company reports their earnings, they're reporting their profits. So earnings means the same as profits, which means the same as net income. Okay, so these are all interchangeable words. So like I said, what do you want as a business owner? What do you want to do with those profits? Well, you want to keep them in the business most of the time. That's what retained means. To retain is to keep in. So the retained earnings statement really is the amount of earnings, profit that has been retained, kept in the business. That's what the statement tells us. What else could happen to that profit? Like I said, it could be shared in the form of a dividend with the owners. And so this statement tells us how much is retained and how much has been sent out in the form of a dividend. The last statement, oh, and both of these statements, by the way, the income statement's always done first, always, because owners want to know if they have a profit or a loss. And then the retained earnings statement is always done second because it tells the story of that profit or loss from the income statement. So you can't do the retained earnings statement without knowing what the income statement says. So these two are always 1 and 2 in the order of how we do it. Another thing to note too about income statement and retained earnings is they tell a story of a period of time. They measure profit and loss on a period of time. The most common period of time it's measured is a month. Month to month, they will have an income statement showing whether this month was profitable or not. 3-month period of time is called a quarter. And quarters are very big on Wall Street, for example, for earnings, quarterly earnings. That's what Apple had last night. That's what Microsoft had last night. That's what Facebook had the other day. They report quarterly earnings all the time. So it's a 3-month period of profit and loss. The most period of time that they will look at a profit and loss is a year, which is a 12-month period. Okay, so that's how those statements are measured. They're measured by periods of time, month, quarter, and year. That's a little bit different than our next financial statement here. The balance sheet simply tells us, it's a financial statement that tells us as of a particular day, okay, what are the assets of the company? What are the liabilities of the company? And what is the stockholders' equity of the company as of a particular day? Now that means you have to kind of get out your phone and do like a little selfie, because that's basically what a balance sheet is. It's sort of a financial selfie of what we look like today in terms of our assets, liabilities, and stockholders' equity. These 3 statements are going to be the focus of what we do here in this particular chapter and in this course. And so you have to know about these quite well, and you will over time. The balance sheet is always the third financial statement that is prepared when we actually do these types of things. Now, the fourth financial statement is very important, but we're going to be dealing with it a little bit later in your studies. It's called a statement of cash flows. And basically, this particular statement simply follows the flow of cash. It only looks at cash. And there's only 2 ways cash can flow, right? Cash can flow into the business and cash can flow out of the business. So it looks at inflows and outflows of cash throughout that particular period of time. This also measures a period of time. So that's basically this particular statement we'll be dealing with again much later, but it focuses on what's happening with cash. Okay. Now, these statements are prepared. There's certain ways that we have to prepare an income statement because there are certain rules in accounting that teach us this is how financial statements are supposed to look. And those rules are listed down on the bottom here. You're going to learn a lot more about them in chapter 2. But GAAP simply means generally accepted accounting principles. And that's basically the rules of financial accounting, which is what this course focuses on. All right, let's take a look at the financial statement here. Your book created a fictional company for you called Sierra Corporation. Sierra Corporation does tours of the Sierra Nevada region. Sierra Nevada region is up in California. And so that's all they do is they give tours. So this particular business is a service business because what it sells is tours. Its main revenue, what it sells, is tours. That's it. So notice that the revenue account that's listed is called service revenue because they're providing a service. Okay. Notice too that this particular income statement measures the month ending October 31st, 2017. So this income statement tells us everything about what happened to the company between October the 1st and October the 31st regarding its revenues and expenses. Okay. So this is the setup too. You have to also learn that this is the setup. These are really good things. These are good slides to kind of print or have handy so you can use them as a template to do your financial statements as we go into our homework. So revenue is a general type of account, meaning, what we sell to our customers in order to collect money from them. Service revenue is a very specific account saying that we are providing a service. So this particular company collected $10,600 from its customers. Now, again, that means they sold $10,600 worth of tours in the month of October, because that's what they sell, and that's what revenue is about. Expenses had to happen because they actually had to spend money to get the store up and running to sell those tours, okay? So they certainly had to have an office, and so they have a rent expense. Most businesses rent their space. They have a lease on their spaces, and so they will have a regular rent expense every particular month. But this is a service company, which means that you are paying them to do work on your behalf. So who does that work? Their employees. So salaries and wages are the largest expense for all service businesses. That's true for this particular company, Sierra, who's paying people to take other people on tours. It's true for this college because we're a service business. It's true for a hospital, a law firm, an accounting firm. It's true for your local, beauty salon, or a barbershop. They are providing services. That's what they do. And so you have to pay people to do that. And that's the biggest expense for service businesses across the board, no matter which one you look at. There are lots of other types of specific expenses. Notice that expense is simply a category showing it's the cost of doing business for this particular month. But then look, each and every expense is titled exactly what we spent the money on. And you have to understand in accounting, we are specific. Okay, I hate when companies use miscellaneous expense. I mean, if you cannot have the words to describe what you just spent the money on, you might need to think about, a lot of things in your life. But basically speaking, you need to specifically state what you spent money on as an expense that particular month. So here we had a supplies expense because we used up supplies. Depreciation expense, you're going to learn a little bit about. It goes along with long-term assets. So if I had a delivery truck for my pizza shop and I'm selling pizza and I have my delivery truck, that truck is going to last me several years. But I also am going to use it to deliver pizza, which means I'm going to be using up its value in delivering my pizzas. And so I can expense a portion of that very slowly over time. And that's what depreciation tells us. Interest expense is simply if a company has a loan, and a lot of companies have loans, the interest they pay on a loan is the cost of the loan. And so they can expense the cost of the loan. They can't expense the loan, they can expense the cost of the loan, which is an interest expense. And then they will also have insurance expense. Every business will have various types of insurance to protect itself in the type of business environment it's in. Usually when you buy insurance, because a lot of you already have car insurance or whatnot, you buy it for a period of time, usually 1 year, say for example. So when you buy insurance today, you're buying literally 12 months of protection. So you use your insurance a little at a time. So as you use your insurance, you can expense your insurance, and that's what it is. It's not an expense when you buy it, it's an expense when you use it, okay? And you're gonna see that happen. So all of these expenses are individually listed and the total is here. Now this is good news for Sierra Corporation because they had $10,600 of revenue, but they only needed $7,740 of expenses to run that business that month. So that means that the month of October was profitable for them. They had a $2,860 profit in the month of October. So what happens? This is the very, very first statement that we do, is the income statement. This is the statement owners want to know first. Did we make a profit or a loss? Again, the income statement measures a period of time, like a month. The month is the minimum amount of time. The year would be the maximum amount of time that we would do this. So what happens to the profit? Well, that's what the retained earnings statement tells us. The retained earnings statement tells us the story of, okay, now that we know we had a $2,860 profit from our income statement, what happened to it? Okay, how much of it has been retained at the end of the month? So retained earnings is how much of the company's profits have been kept in the company. Well, what else can happen to the profit? It can go out in the form of a dividend. If it's going out in the form of the dividend, it's going out. It's not being retained. It's being sent to the owner's personal accounts. It's not a corporate account anymore. So these are the two basic things that a retained earnings statement will tell us. It measures the exact period of time of the income statement because it's the story of the profit. It'll always start with a beginning balance in retained earnings. And because this is a brand new company, the beginning balance would be zero because it does not have any previous income statements with profits or losses. Okay, so the retained earnings statement at the beginning for Sierra is at zero, as it is for any new company. We just said that it earned $2,860 of profit, so that gets added. We realize, and the book will tell you through the examples how much the dividends have been. We realize that we are taking some of that money and sharing it with the stockholders in the form of a dividend, so we're subtracting that out. The remaining portion of the profit is being retained in the business. So the retained earnings at the end of that month is $2,360. Okay. The retained earnings, again, is represents the owner's profits that have been retained in the business. Right. So what happens to these owners' profits? How do we show that these belong to the owner? Well, it'll show up on the balance sheet. The balance sheet, as I mentioned to you earlier, is simply a financial selfie of what we look like today. And today for Sierra Corporation is October 31st, 2017. And what the balance sheet tells us, generally speaking, is what our assets are as of a particular day, compared with what our liabilities and stockholders' equity are at a particular point in time. Okay. The thing is that the amount of assets needs to equal the amount of liabilities and stockholders' equity. So that total assets need to and will always equal liabilities and stockholders' equity total. Okay. So again, assets are resources that the company owns. They have a particular way of being listed on the balance sheet, which you're going to learn a little bit about in this chapter, and you're going to find in chapter 2 exactly what the structure looks like in more detail. But right now, you need to understand that assets are listed in something called liquidity order, which means they start with cash and they're listed accordingly. So cash is listed first. And when we say cash, we really mean the total amount of cash the company has. And most companies don't just keep cash in a drawer in their office. Everyone has a main bank account. Okay. And so most of companies, corporations' cash is kept in the bank, in a bank account. Yes, they do have some cash with them in stores and in the offices, so that'll then be included. But certainly you keep most of your cash safe and insured in the bank. Accounts receivable, you learned a little bit about in Objective 2, where you see that you're waiting to receive money on an account. Why are you waiting to receive that money? because you already did work for that person and you're waiting to receive the payment for that work. So that's an accounts receivable. Companies of all sorts use supplies. When you buy supplies, they are your asset, okay? Now, supplies will be used pretty quickly. And so once they are used, then you'll see it on the income statement as supplies expense. And I went over supplies expense briefly, just a couple of slides ago. But there's a connection. It starts as supplies, but once we use it, it becomes supplies expense. The same thing with insurance. Remember, when you buy insurance, you're buying coverage for a, say, 12-month period of time. So it starts off literally as an asset. However, as the months go by, month to month to month, you're using up your coverage. And as you use up your coverage, you can expense what you've used up. So supplies and prepaid insurance have that in common. This will show up as insurance expense once you've used up that part of the policy. Equipment is considered what we call a long-term asset for businesses, which means they plan to use them for much longer than a year. Most of the time, it's several years, okay, depending on what type of equipment it is. Equipment is an important asset for businesses, but they use that equipment to generate sales of whatever they're selling. And thus, they are going to be using up a portion of its value over time to sell stuff. And thus, they're allowed to go through a process called depreciation. Way in the future, Chapter 9 really looks at depreciation in detail. But just to know that once something gets depreciated, it can be expensed in that month that it's depreciated. So those are your assets. And here you have $21,910 of assets, right? Which means you need to have an equal number of liabilities and stockholders' equity. Well, let's see. Liabilities are, as you know, from Learning Objective 2, things that the debts that the company owes. And a very common title with a liability account uses the word payable at the end. So a note payable, remember, a note is a loan. Most notes are short-term loans, which means they're less than a year. Accounts payable is simply a bill that has to be paid in 30 days. Salaries and wages payable are salaries and wages that have already been earned by your employees, and you need to pay them on the next pay date. It stays on your books as payable. Salaries are payable until you actually hit the payroll date. And some loans have interest that will be paid at a future date, so they'll have a interest payable. One of the most interesting liability accounts that you need to know about, because it's a very important one, is something called unearned service revenue. And it's a very interesting account because it sounds like service revenue. Well, it does sound like that, but it's unearned, which means in essence, you haven't earned it yet. So what happens here is the client pays you up front, and thus you owe the client, that's why it's a liability, you owe the client what they paid you for. And this is actually very, very common in a lot of businesses. So for example, and I know everyone here has probably been on some type of vacation. And so normally speaking, whether you're going to, Florida or other places, oftentimes you are paying up front for the airline ticket. You're paying up front for the hotel. Or if you're going on a cruise, you're paying up front for the cruise. Well, when a company gets your money because you paid up front, they can't say they earned it. So it's not revenue for them yet. It's the revenue, remember, is earned. It's an amount that you earned by doing something for your client. So they have to actually say it's a liability. The airline owes you that flight. The hotel owes you those nights there. The cruise company owes you a cruise. So it has to show up as a liability because they literally owe you that They can't say they've earned any money because they didn't do anything for you. They just take your money up front. So that's why it's a unearned service revenue. So in this case, people paid up front for tours, and Sierra Corporation owes them those tours. So it's a very important account to know about. So then your liabilities are added up here. Stockholders revenue, stockholders equity. The words get twisted after a while. There are two specific accounts that represent owners' equity or stockholders' equity. Common stock is the number of shares of ownership that they have. So $10,000 worth of common stock is the ownership, represents the shares of ownership. But as you noticed here in the retained earnings statement, they have profits that they want to keep in the company. These are the owner's profits. So retained earnings is an owner's equity account. Okay. And so when you add these two up, you get $21,910. They must balance. They must balance. One of the more important equations you're going to learn in accounting, and it gets repetitive, so you will actually end up memorizing it, is this balance sheet equation. It's also known as the accounting equation. Assets equals liabilities plus stockholders' equity. That's very, very important to know and remember. Okay. Lastly, they do give you an example of a cash flow statement, and I will briefly review it with you. Again, it simply looks at cash flowing in and out of the company. And here's where you have some familiar terms: financing activities, investing activities, operating activities are all listed on the cash flow statement. So these activities either bring money into the company, bring cash into the company, or use cash. Okay. So you're going to see either provided or used. The numbers here indicate cash. A positive number isn't really a positive number. It simply means cash flowing in. A negative number simply really isn't a negative number. It simply means cash flowing out. Okay. So this company started with nothing, no cash, but after all of these activities, they have $15,200 of cash, and that's also the same amount of that you'll see on the balance sheet. So that's how they are connected. Okay. All right. So your book has a do it exercise. Learning objective 3 in the book is broken 3A, 3B. It's not broken up that way on Wiley, on the Wiley Plus site, but your homework is broken up this way. Okay, 3A, 3B, just to distinguish it between the two parts. The first part is all about the financial statements. As you know, it's the heavy lift here. You're going to be spending most of your time doing financial statements. This is a time-consuming part. It's not that it's difficult to do, but it takes time. All right. So here is an example that you should review. A corporation, CSU, they just began operations on January the 1st of 2017, and now they are done with their very, very first year of operations. There's a whole bunch of accounts, with numbers here, except this is a big question mark. And they want you to do your preparations, right? So always, 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 the income statement is prepared first, right? So you have to think back, okay, so what is on the income statement? Revenues are listed on the income statement first and foremost. And so look here, we have a revenue account. This is going to be on the income statement. That's your service revenue. Expenses are listed on the income statement as well. So what are the expenses? Well, there'll be very specific accounts like supplies expense, like rent expense, like insurance expense. Those are three expense accounts, very specific expense accounts that you see here. So those are your three expenses. So those service revenue and all of your expenses are going to be on your income statement. And that's the very, very first thing that you prepare. So your income statement is going to look like this. It's going to show for the end of the year for this company $17,000 of service revenue. 3 expenses that I pointed out are listed and totaled to the far right. And because their revenue is much bigger than their expenses, they have a profit for the year. Okay, net income is the same as profit, which is the same as earnings. They have profit for the year, $6,800. So that's the very, very first statement that we do is the income statement. Right. The next statement that we do is the retained earnings statement. And as you notice, the retained earnings has a big question mark because you have to prepare the retained earnings statement to get what that question mark is. Retained earnings statement has, of course, 2 things for sure on it. The net income that you just calculated, right? And dividends. Dividends are provided for you right here. So it looks like they did take $600 of their profit and shared it with their owners in the form of a dividend. So now your retained earnings statement, which is the second statement you do, starts with a 0 balance because it's a new company. We add the net income. $6,800 was the net income from your income statement, the one you just calculated. And we subtract out the dividends of 600 that was shown on that list of accounts, which means the amount of profit that has been retained in the company at the end of the year is $6,200. Remember, the retained earnings are the owner's profit. So they'll show up on the balance sheet as part of one of the owner's accounts. And the very third thing to do is prepare the balance sheet. Balance sheets start with assets. So when you look at all these accounts, you need to look and find the assets. So accounts receivable is an asset account. Equipment is an asset account. Supplies is an asset account. Cash is an asset account. So that's important to know. Another thing that's really important to know is once you've used an account on a financial statement, you're not going to use it on another financial statement. So all of these simply, and it might make it easier to follow. Once you've used it on a financial statement before, it's done. Only revenues and expenses live on the income statement. You're only going to find dividends on a retained earnings statement. So all the rest of these accounts are going to be on the balance sheet. It's just a matter of identifying them, which is an asset account. So I've identified 4 here, right? Cash, receivables, equipment, and supplies. But as you know, they have a very specific order. So when you do these, you need to have samples of balance sheets in front of you to do it properly. Okay. Then your liabilities would come. Liabilities are accounts payable and notes payable. Those are your liability accounts. Okay. And then your stockholders' equity accounts, like your common stock account would be there, and the retained earnings from the retained earnings statement would also be there. So when you look at your balance sheet, and this is all done for you and in the book and on Wiley, it's all done for you. You should be printing these things out so you can actually have samples in front of you. Your assets have a very specific order that you learned if you looked at the balance sheet. Total assets of $23,200. Liabilities have a particular order and they're totaled. Stockholders' equity has a particular order and then it's totaled. These 2 totals happen to be $23,200 as well. Okay, so our balance sheet balances. This is what a large part of your homework is going to be. Okay, this is what you're going to be spending a lot of your weekend doing. It's critically important to understand these statements. And one of the best ways to actually understand them is to do them. But you will need to know the accounts and you will need to know where they belong. Balance sheets only have assets, liabilities, and stockholders' equity accounts on them. You will never, ever, ever see a revenue account here because revenues live on the income statement. You will never, ever, ever see a expense account here because they live on the income statement. So understand that these accounts live on specific financial statements. And that's also part of your work to do, is understand where they belong. Learning objective 3 ends with a little information about what's called an annual report. So if a corporation is publicly traded, and we were talking about GameStop, we were talking about other companies earlier in our conversation. Well, the reason we're talking about these and they're in the news is because they're publicly traded corporations. In other words, a publicly traded corporation is a corporation anybody in the public can own simply by buying a share of ownership on the market. Okay. And so that's a public corporation. But because they are publicly traded corporations, there are rules set by the government through the SEC that they have to keep the information, the financial information, flowing, okay, to the public, to everyone who can be an owner. So the annual report requires and has a few pieces of information that needs to be disclosed to their owners, but also it's available for anyone in the public to look at. So one of the things you are going to see for sure is you're going to see these financial statements that you just learned about in an annual report. And because it's an annual report, it's going to show the full 12 months, okay, worth of data for their income statement, for example, and their retained earnings statement and their cash flow. With the financial statements, because there are lots of numbers on those financial statements, there will be notes to them. So actually these two parts go together more so. But the largest part of the annual report will be managers discussing the business. They have to highlight the risks and the pluses and minuses of what's going on, you know. So that's really, that's the biggest part of a data report, is management discussing everything. And then the GAAP requires that an independent accounting firm, which means an accounting firm that the company's not doing business with regularly, to come into their offices and audit their books and audit their report, which means that you'll have an independent accountant come in as an auditor, look to see if these financial statements are prepared properly, and then write a quick report saying, yes, these statements have been prepared fairly and they have been following the rules that are set, which we call GAAP, Generally Accepted Accounting Principles. So that's how this particular chapter ends. Again, these are just the parts of the annual report that are outlined in the book. Yes, they are important in general, but your heavy work here is going to be the financial statements. Okay. And by the way, auditors are CPAs. Right? They have to be a CPA, because a CPA is someone who is an expert in GAAP, Generally Accepted Accounting Principles. These are the rules that you're learning in this class, and they're good rules to know. But they only really work for public corporations, but that's important too. All right, so I'm going to bring us back to our bigger class here and ask if there's any questions.